Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about constructing a cryptocurrency portfolio and how to do so if, say, you're investing $1,000 into crypto. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we do this video about every 6 months, right? There's actually a playlist. If you're interested, there's a playlist on the channel called Modern Portfolio Theory. And you can see, the last one we did was about 7 months ago. We got one a year ago, 2 years ago. We got plenty that were 5 years ago, 4 years ago, 3 years ago, 2 years ago, right? So on average, we do this video. I try to do it about every 6 months because for me, I don't really change my portfolio that much on during shorter periods of time, right? It's more of a longer term thing. And so what we're going to do is we're going to use something called modern portfolio theory. It's a classical theory in economics to help people construct portfolios. Now, typically this is used in traditional markets, and hedge funds might use variations of modern portfolio theory to construct portfolios, but we're going to get into this and how you can use this in crypto. How do you use it in crypto? Well, let's understand what we're talking about. The first thing we can do is we know what historically has happened, okay? Now, what we're going to do in this video, as I've said before, is we're going to take what has historically happened and use that and assume that things will evolve in a similar fashion in terms of volatility. Obviously, you have diminishing returns, but volatility is something that you can look at through the cycles. You can see what's outperforming what when, and thereby you can construct a portfolio and say, all right, my expected return is this, not based on what I think, what I want to happen, just based on what we know has historically happened, right? And then, but we know that there's always volatility, right? And anything can happen at any point. Think back to March 2020 when it looked like the markets were clear to go, and then we had the pandemic. Look at April 2025, right? A lot of people were really bullish going into the new presidential administration, but what ended up happening was we got a drop, which made sense. I mean, and we talked a lot about that, the idea of January 20th being a local top, because of perfection being priced in the short term. Now, what we're going to do is we're going to figure out how you can construct a portfolio based on risk-adjusted returns. There's one thing that people will do, and they'll talk about all these micro cap cryptocurrencies that might go up a lot in really short periods of time, and then they drop just as much they went up the next day. And so it doesn't really leave you. It's more of a casino. It's not really investing. It's more of a casino. And there's nothing necessarily wrong with gambling in a casino if that's what you want to do, but on this channel we're more so focused on long-term investing. Well, at least I am. And I imagine a lot of you guys are as well at this point. So the idea, this chart shows us the expected return based on historical returns, noting that obviously the past doesn't necessarily predict the future, on the y-axis. And then on the x-axis, you have volatility or risk, right? It's your risk. So what this means is that in any given year, if you had a portfolio right here, this is consisting of Bitcoin and Ethereum. If you had a portfolio right here, let's say 83% Bitcoin, 17% ETH, then your expected annualized return would be about 65%, 0.65, so 65% plus or minus 70%. Now, let's get the collective eye roll, right? Because you're saying, all right, well, expected return 65% plus or minus 70%. That means my expected return within one standard deviation with the monetary ratio, we could still see a loss if it's plus or minus 70%, right? That can still be a negative 5% on average, some years. But the point is that over a long period of time, right? Every individual year is going to be different, but over a long period of time, a portfolio consisting of, say, 83% Bitcoin, 17% ETH, historically, on average, would be expected to return about 65% annualized. Now, that might seem crazy, right? That might seem crazy. If you go over to the Bitcoin chart, you look at just 12-month candles, you can kind of see what I'm talking about, right? So you have, 2023, 155%, last year, 121%, right? This year has been 27% so far. So you can see how, on average, it might end up being about that, especially if you factor in a bear market year, right? Like if one year you're down 65%, and then the next 3 you're up between 27 and 155%, then on average, it kind of makes sense. All right, about 60 to 65% annualized return, noting that some years you're going to get cooked, more than likely, right? You're going to get cooked because the markets are going to go down approximately every 4 years. Now, how do we come up with a weight? Well, there's this formula called the Sharpe Ratio. Now, the Sharpe Ratio is the return of a portfolio, RP, minus the risk-free rate, RF, divided by the standard deviation of the portfolio's excess return. What the hell does that mean? Right? Well, the return that we're looking at, in this case, is based on historical returns. Now, that has a lot of downsides to it, and we'll talk about that in a minute. But that's what the return is, right? It's what you think it's going to be. In this case, it's what we've seen historically. The next one is the risk-free rate. Well, what's the risk-free rate? The risk-free rate, in this case, the way I like to think about the risk-free rate, and I think a lot of other people do as well, is the 2-year yield. Think about the 2-year yield as the risk-free rate, right? The 2-year yield is basically what you can go get in, say, like a CD, a certificate of deposit, a T-bill. It's relatively risk-free, right? Buying a T-bill. Now, is it 100% risk-free? Nothing's technically risk-free. But, if you're buying a T-bill and you're going to get 4%, if something happens and you don't get paid out, like, there's way bigger problems going on in the country than the prices of Bitcoin and Ethereum, if that happens, right? So the risk-free rate, arguably, is the 2-year yield, because it's 3.8%. If you just put cash in it, if you put, say, you go buy a T-bill, 2-year T-bill or something, you're going to get, or a CD, you can get about 4%. So your risk-free return, it could be considered, a short-term T-bill, divided by the standard deviation of the portfolio's excess return. What's the excess return? Well, the excess return is the return beyond what you could get from the risk-free rate, right? If you can get 4% from the risk-free rate, and you buy an asset that yields you 2%, you might feel good, but then you look back and you're like, oh, I took on risk and I got a lower return than had I just bought something that gave me the risk-free rate, a T-bill, right? 4%. So in this case, the denominator is not the standard deviation of the return. It's of the excess return. So beyond the risk-free rate. Now, in 2021, the risk-free rate was essentially 0%, right? You couldn't really get anything, because look at the 2-year yield. The 2-year yield was basically 0%. So that was why the markets were going crazy, because even conservative investors that wanted to just get a easy 4%, 3%, 4%, couldn't even do it. So a lot of those guys were forced to invest in the markets if they wanted any return at all. Because otherwise, what are they going to get? 0.1%? No one's getting out of bed for 0.1%, right? It's like nothing. I mean, it barely keeps up with inflation tomorrow. Not alone what it is annualized, at least back then. So we've defined what we're talking about now. The Sharpe ratio is the return of the portfolio based on historical returns. Now, hedge funds might use projected returns, right? They might look at it and say, well, this year I think Ethereum is going to outperform Bitcoin. Therefore, I maybe want more Ethereum than in past years. And I project, if you say project Ethereum to go up more than Bitcoin at a certain period of time, then that would actually change the formula. We're looking back, going back many, many years. Now, unfortunately, one of the caveats of the Sharpe ratio is you cannot use the price history of the cryptocurrency as far back as it goes if you're comparing it to newer cryptocurrencies. So in this case, because we're looking at a portfolio consisting of just Bitcoin and Ethereum, we can't even look at Bitcoin's price history back in 2011 and 2012 and 2013. We can only use Bitcoin's price history since Ethereum has been around, which is going back to 2015. Now, if you do that, and you wanted to calculate the portfolio that maximizes your risk-adjusted returns now, then the Sharpe ratio is maximized at 0.703 volatility, which would give you 81% Bitcoin and 19% Ethereum. 80, let's just call it 80-20. 80-20. Now, a few years ago, back in 2021, when we did this video, it would have been a little bit less Bitcoin and a little bit more ETH. I don't remember exactly what it was. It might have been 70-30, maybe even 65-35. I don't remember. But if you guys remember what I said back then, what did I say? This is based on expected returns annualized, but we can use a little critical thinking back then to say, all right, well, if the Fed's going to go through with higher for longer, then likely we're going to want more Bitcoin than Ethereum, and let's just get on the Bitcoin dominance bandwagon, which is why I was basically just 99% Bitcoin in my crypto portfolio for many, many years. I didn't care about this because I was convinced that the Ethereum valuation against Bitcoin was going to bleed, and it did. So I didn't waste 4 years of my life having 20 to 30% of my crypto portfolio locked up in ETH while it was bleeding against Bitcoin. But I think the case can be made that Ethereum has bottomed against Bitcoin at this point for this cycle. I really think it has. I also hope it has, because if it hasn't, then you break your higher low structure. All right. So a portfolio consisting of just Bitcoin and Ethereum, and I'm going to get to you XRP guys in a minute, a portfolio just consisting of Bitcoin and Ethereum that maximizes your Sharpe ratio or your risk-adjusted returns is about 81% Bitcoin, 19% ETH. If you think that ETH has bottomed against Bitcoin and think this number might shift in the coming months, you want to prepare for that now, not wait for it to reflect on here. That would be plugging in what you think the return is going to be this year, not just an average annualized thing. All right? But about 80-20 is what the Sharpe ratio would have it at. Now, there's an issue with that. Just when you thought we had it figured out, right? There's an issue. The Sharpe ratio has a big drawback in that it punishes volatility in both directions. If there's a lot of volatility to the downside, that's a bad thing, right? We don't want to watch the market go down. But if there's volatility to the upside, it'll punish it. Like, it'll say, like, if Ethereum goes up 100% like it just did since April, a little bit more, actually, I guess it's up, what, 200% almost, right? 200%. That's kind of a punishment because there's a lot of volatility. Now, that's a good thing, right? I mean, everyone here wants there to be volatility to the upside, but the Sharpe ratio will punish that and consider it risk. So what we can do is use sort of the brother of the Sharpe ratio, or maybe the long-lost cousin, the Sortino ratio. Now, the Sortino ratio does not punish positive volatility. And in this case, the Sortino ratio is maximized at 0.7 volatility and would yield 83% Bitcoin, 17% ETH. Now, if you're an investor that just wants to minimize your volatility, then you're looking at 93% Bitcoin, 7% ETH. If you just want to be more conservative, right? If you want to just kind of be like, yeah, like maybe it's okay to have some other cryptocurrencies, but, you know, I just want to stick with Bitcoin for the most part. Then you're like 93.7, right? Where you have almost 95% of your portfolio in Bitcoin. But, you know, you got a little bit, right? You got a little bit maybe in Ethereum. And perhaps the person following that view would just be taking advantage of, say, a rally on the ETH Bitcoin pair to eventually just get more Satoshis. If you want to think about it like that, right? Perhaps they are a Bitcoin maxi, but they're using the idea of any type of mean reversion to just get more Satoshis. Okay? Now, some of you are thinking, well, that's great, Ben, but what if I don't want to reduce my volatility? What if I want to step into the casino and say to hell with risk-adjusted returns? Well, in that case, you would want to go further up the efficient frontier and go higher on the x-axis, which would access you more volatility in both directions. What you'll notice, if you look at, you can see as I hover, it'll show you the portfolio percentage. You can see that as I go higher, it becomes less percent Bitcoin and more ETH. You see that? You see how the further up I go, it yields. And the great thing about this has nothing to do with my opinion, right? My opinion, you can throw it out in the window. It doesn't matter, right? It's completely useless. Market doesn't care about your opinion or my opinion. This is just based on data. As you go up the efficient frontier, as you go up the volatility axis, you'll see that it yields less and less Bitcoin and more ETH. Meaning, if you want to seek a higher return than 65% annualized, you can do that, but it's going to require more ETH than Bitcoin. The problem is that a lot of people did this for the last 3 years thinking they would outperform Bitcoin by having more ETH because they wanted to take on more risk and therefore get a higher return. Unfortunately for them, they took on more risk and got a lower return because ETH Bitcoin, the valuation of Ethereum against Bitcoin just dropped for years. So they kept taking on more and more risk, but they would have been better off with Bitcoin. If looking at the Bitcoin valuation or looking at the Ethereum valuation on its Bitcoin pair doesn't make a whole lot of sense, look at it like this. Think about it like this. Think about the inverse of it. In 2021, one Bitcoin was worth 11 ETH. In April, one Bitcoin was worth 56 ETH. See the difference? Right, that's the difference. And now one Bitcoin is worth 31 ETH. So you could have converted your Ethereum to Bitcoin in 2022, when I did, and just by holding Bitcoin, even through the bear market, and then just continuing to hold on to it, holding it, you could have gotten 5 times the amount of Ethereum by just converting your ETH to Bitcoin at the end of 2021, and then converting back when ETH went home. Remember when ETH went home? If you converted back when ETH went home, that was the time. I keep bull posting about ETH Bitcoin. I'm not saying it's not going to ever come back down. It almost certainly will. My point is that this to me still looks constructive, and that looks like the low to me for the cycle. Doesn't mean it can't come down again, right? Doesn't mean it can't do that. It probably will. Like, I mean, it could go up, it could come back down, right? It could do something like this. But in this case, this whole idea has worked out incredibly well. So now, I would argue, ever since ETH went home, taking on more risk with it has worked out. Right? It has worked out. Now, this is kind of a the portfolio is two-dimensional, right? It's just Bitcoin and Ethereum. And some of you guys are screaming, well, why don't you include an altcoin? The problem is that it's only really good to use if you have an altcoin that has a lot of history, and we don't have a lot of those because a lot of the altcoins that are around for one cycle are not really here for a future cycle because they just go asymptotically to zero on their Bitcoin pairs. But one of the ones that has done better recently, right? XRP. And one of the things I told you guys back in late 2024 was that this was a double bottom. And just like the double bottom that we got over here, it was likely going to yield a rally by XRP on its Bitcoin pair, right? You look for these double bottoms, right? Where you get a low by an altcoin on its Bitcoin pair, and then you look for it to retest that low. It's not the first time it's happened, right? That is ultimately what you want to look for, the lows and double testing, double bottoms on all Bitcoin pairs. And so when you add in XRP and you recalculate this, again, this is not my opinion, okay? It's not my opinion. This is just based on the historical record. The portfolio that maximizes your risk-adjusted returns, or in this case, your Sharpe ratio, would be about 76% Bitcoin, 17% ETH, 7% XRP. But if we want to go to the long-lost cousin of the Sharpe ratio, the Sortino ratio, 82% Bitcoin, 15% ETH, 3% XRP. Now, you might say, Ben, your bias is showing, right? Just if you don't like XRP, just say it has nothing to do with that, guys. This is just based on what XRP has historically done. I don't control what it's done. I don't control it. Neither do you. No one controls it. This is just what's happened. And it's true that XRP has absolutely outperformed Bitcoin ever since the double bottom. And I said it was likely going to. And I said that was likely going to be a low for a long time. The problem is that even with this rally, it still is, look at where it was in 2017, right? Like 8 years ago, the XRP Bitcoin valuation was so much higher. So yes, it's easy to look at these pumps and be like, oh man, I should have just, you could think you should have just gone all in. But the reality is that the XRP Bitcoin valuation hasn't even been anywhere close to its highs from 2017 and 2018. And it's been 8 years. That's why it only suggests single digits for that cryptocurrency. Because yes, it's done well recently, but this is not just based on what it's done this year. It's based on what it's done every year since 2015 in this case. And if you look at monthly candles for the XRP Bitcoin ratio, you'll see that look at these massive red candles by it. You see these massive candles? These candles to the downside significantly impact the risk-adjusted returns because you know that at some point you might just see XRP drop 70 to 80% against Bitcoin, and that's what's leading to it to be sort of a lower amount. So in this case, you might notice that this chart looks a lot different than just with Bitcoin and Ethereum. That's because it's three-dimensional now, right? In terms of the number of assets. Now you're looking at 3 of them, and the sort of this line up here, this is the efficient frontier. The red line down here, you don't want to be down here. Why don't you want to be on the lower part of the chart? Because in this case, you're taking on the same volatility as someone up here, but this person has a much higher expected return than you do. Right? You see the difference? You want to be on the efficient frontier, which is this line up here. This is called the efficient frontier. You can see it's labeled. That's where you want to be. Up here. You don't want to be down here. Because then you're taking on the same amount of risk as someone who has a 10% higher expected annualized return than you do. Now you might say, well, hold on a second, Ben. How do you know that this is what maximizes your risk-adjusted returns, right? How do you know? It looks like you ran 50,000 simulations, but what if you ran 100,000 or a million? Would it change? And you're right, a Monte Carlo simulation does have its drawbacks, because you always wonder, had you run 50,000 more, would you get different results? Fortunately, in mathematics, we have other tools that we can use, in this case, quadratic programming. And by using quadratic programming, it allows us to identically solve for things like the Sharpe ratio without wondering if, had we ran 50,000 more simulations, had we gotten a different result. So if you do take the Monte Carlo approach, you will converge to the right portfolio weights. Those still slightly change. Or you can just use quadratic programming and you can calculate your max Sharpe ratio. You can also come in here, and if you want to add, say, US dollars, you could add that in and see what happens to the chart. And it looks kind of weird, honestly, when you add in US dollars. It's not normally meant, I don't think, to really be in there in this way. But if you look at it like that, and let's just take out XRP, if we take out one of the cryptocurrencies, maybe it'll look a little bit, no, it still looks about the same. But in this case, you can see it. I mean, it says about 1/3, about 1/3 cash. If you're going to go beyond just that. Now, for a lot of people, that's too much, right? A lot of people, they don't want to keep 1/3 of their portfolio in cash. But I think the main reason for that in the crypto case is just because, you know, every 4 years or so, you get these like massive drawdowns of like 70-80%. And so if by having some over a longer period of time, it allows you to sort of take advantage of that, right? And that's the thing, right? I mean, if you're just 100% allocated to the market at all times and the market drops 80%, you know, like, what are you going to use to buy? It's easy for influencers to, you know what I've noticed a lot of influencers do? Ethereum's a great example, right? Ethereum's a great example. Even some well-known people have done this recently. I won't mention any names, but you know, they'll shill XRP or Ethereum or Bitcoin or whatever it is, right? They'll shill it at a very high level, right? They'll be like, all right, buy Ethereum or buy Bitcoin or buy XRP, and then the market will drop. And they will have said nothing about having any cash at the highs. But then they'll bull post the entire way down. And then when it's back up here, then they'll say, see, I told you I was right, right? But the problem is, had you listened to their view, you would have already been all in right here at 4K for Ethereum. So when it went home, you would have had nothing to buy it with, you know? And so what ends up happening, I've seen this happen so many times, right? Someone will be bullish on it way up here. They'll be bullish on it. They'll mention nothing about having any cash whatsoever, right? They'll just say cash is trash, don't have it. Then it'll drop 65%, and then they'll say they're buying. And I want to say, with what? With what? If you were already 100% allocated over here, what are you buying it with down here? And that's the problem with, you know, a lot of influencers, is that there's no accountability, right? Like, they won't ever mention the idea of, hey, it might be a wise idea to have some cash in case this outcome plays out. And then they give me a lot of flack for it because I'm willing to say, look, Ethereum's going to go home. And then I'll give a range and I'll say, all right, it'll probably bottom between 1,200 and 1,500. That is what I said. And then I put out a video when it went below 1,600, and I said I was buying, right? I said, this is good enough for me. I don't need it to go any lower. It's good enough for me. So I bought Ethereum. And then they come back out. They'll have no clue that I turned bullish on it when it went home, because all they know is I was calling for it to go home, so they think I was bearish on it. They won't recognize that I put out a video called Welcome Home Ethereum, where I pivoted, and I pivoted on everything, basically, for Ethereum, even on this Bitcoin pair. And they'll be like, oh, look, Ethereum is up from the low almost 200%. Right? That's what they'll say. Like, yeah, but you were shilling it at 4K, you know, just a few months ago. And so that's the problem, right? The problem is that whenever anyone talks about having any cash at all, there's a lot of like these influencers that just shill random altcoins nonstop that will never mention having any US dollars because cash is trash, right? They'll never mention it. But the minute the market drops, they'll say they're buying. And I just want to be like, with what? With what? If you followed this view when I posted it 7 months ago, what did we say? Go watch it. I would encourage you to go watch it because we said in that video about 1/3 cash is right, so that if Ethereum goes home, you can buy it. That's the idea, right? That's the idea. And that's what I said back then as well, right? If it goes home, then you can buy it. And you can use the money to then DCA assets that you want to hold long term. So again, that's how you navigate crypto. There's nothing wrong with having a small portion of your portfolio earning the risk-free rate so that you can use what it generates to then buy. So if you're saying with what, if you have a small portion in cash earning the risk-free rate, that's with what, right? Even if you want to keep the portion just sitting there long term, you could always use what it generates to then buy risk assets. So then you know what is with what. It's with the US dollars that you have because you're not 100% allocated in case you get those drawdowns. So that, I think, is how you navigate the cryptoverse, right? You have, for over a long period of time, having most of the exposure to Bitcoin is where you want to be at any point in the cycle. Obviously, things can outperform Bitcoin, but if you guys have learned anything this cycle, if any of us have, right, it's the Bitcoin dominance rally can go on far longer than people think it can. Therefore, it's always a good idea to keep your portfolio more in Bitcoin than any other individual crypto asset. For me, it was like 99% for the entire cycle up until about 6 months ago or so, maybe a little bit less than that, right? Always a good idea to have most of it in well, really maybe a little bit more than 6 months ago, because I started to pivot a little bit kind of around here on the Bitcoin valuation. It did go lower, honestly, than I thought, but when it hit this level, and you look at like Ethereum dominance, right? If you look at like Ethereum dominance, you can see that it had swept this low from the prior cycle. So again, if you're investing in crypto, if you're investing $1,000, you could always use these portfolio weights. Obviously, you can play around with other altcoins as well. We don't have really that many in there because, we just don't have a lot of data for a lot of newer altcoins. It's just not as useful, because if an altcoin launched a month ago and it's only gone up since then, and you're going to compare it to Bitcoin, then it's gonna make everything look out of whack, because it's not going to know what the potential downside is for that altcoin if it hasn't yet gone through a bear market. So that's why you have to only use assets that have been around for a longer period of time, and that's why you can use something like Bitcoin, Ethereum, and even XRP. And I know there's a lot of XRP haters out there. But one thing to keep in mind is that it has been around for a while, and it's been in like the top 5, top 10 for a really, really long time. So whether you like it or not, it's been there. It's probably going to still be there for a while longer. So just keep it in mind. Again, drop the bias at the door. No one cares about it. Stick to the data. Thank you guys for tuning in. Make sure you subscribe to the channel. Give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.